Hello traders, and welcome back to another video. In this video we're going to be focusing on improving one particular element of your trading career and building your ability to succeed one brick at a time. These are the core principles that I use to train traders how to succeed. This is the 20% of trading you need to know to become profitable and grow wealth. Today we're going to look at principle number 1, how to enter and exit a trade. The device that enables us to enter and exit a trade is called a trading strategy, and it's important that you have a bulletproof one, and that's what we're going to work on building. Your trading strategy is responsible for your first touch point with the market, which is your entry into a trade. When you enter a trade, you decide whether to buy or sell a market, and every trade should have a reason behind it. At a top level, there's no such thing as gut feeling or hunch. You need to know the exact reasoning behind why you've decided to enter a trade, which we'll cover in a bit. Your trading strategy is like your philosophy of the market. A strategy is something consistent. It's a set of rules which tells you exactly how to play the market and also what you're looking for, and you keep it consistent every time you execute it. You can't just change something because you feel like it. You do exactly what your strategy says, and you make a note if you think a rule could be changed to make your strategy perform better. You need to think of yourself as a scientist. Any change you want to make to your strategy needs to be tested, and this is like your independent variable if you want to change or adjust something to see if it makes it work better. But the trading strategy that you're using in the market should have already been tested. In other words, you know that it works, and if you decide to test any adjustments, you need to keep trading this version, the version that works. Think of it as a controlled variable. You keep this one the same until you have proof that the adjustment works better before you edit your strategy and make your amendments. Many traders think that they can tinker with their strategy whilst it's live and they're trading it. Don't burn yourself like this. Anything that works in the market should be kept consistent until there's a reason to change it. What I'm describing is discipline. I'd say good discipline is responsible for over 90% of traders who are consistently profitable. And if you want to join that ranking, then you need to be disciplined as well. Okay, let's get into the 3 things you can change today to make your strategy perform better. Principle number 1 is to keep it simple. It's no coincidence that for nearly every trading strategy I've ever come across that actually works, it's simple to understand the reasoning behind why a trade is being placed, and it's just as easy to pull the trigger and execute the trade when the rules are confirmed. No one needs a complex trading strategy to succeed in the market. Actually, I'm of the opinion that making a strategy more complicated actually adds more barriers to becoming a profitable trader. The simpler your strategy, the easier it is to understand, the more comfortable you'll feel trading it, and do I need to mention the more likely it will be to make money or to fix it if it's not quite making money yet. By simple, I usually mean using a maximum of 2 trading techniques. If you're unsure what I mean by trading techniques, then take a look at my 4 pillars of price action, which is a model I use to teach the most profitable trading strategies. The 4 pillars are reading price, candlestick analysis, support and resistance, and harmonics. Each one of these techniques can be used to build trading strategies that have an edge over the market in order to secure profits over time. To go back to my previous point, you don't need more than 2 of these techniques working in combination with each other to build a simple but highly effective trading strategy. Allow me to show you a trading strategy that uses 2 out of the 4 pillars. So in this trading strategy, we're going to combine candlestick analysis with support and resistance for a strategy that has sound reasoning and solid results. This is a combination of a defined area of support and resistance with a pin bar candlestick pattern. For those who don't know the pin bar candlestick pattern, it describes any candle that has a small body and a wick of at least 2 or 3 times the size of its body. It's a very significant candle which signals a potential reversal by showing rejection of the price levels that the wick pierces through. Okay, so let me walk you through this trade. Let's say we want to enter a buy trade, which means we're predicting that the price will rise. So for this strategy, the first thing we need to do is identify a solid level of support. So just going from this price level that we are now, if I just draw a line across, a support level is an area where we have 2 or more bounces of price in our price level. So in this case, we can identify quite a few bounces of price. We've got one here where we are right now at the market. We have another bounce here. We have this, which is previous resistance. We have also a bounce here and a bounce here. So we have a lot more than 2 bounces, and this means that this is a valid level of support. Exactly what we need for this strategy. Each bounce that we've just identified shows a rejection of lower prices. It basically tells us that the buyers are in control because they are stopping the sellers from pushing the price lower. Because this level has been held up in the past, we can make the assumption that it's likely to be held up again in the present. So if price comes into contact with this level again, which it does right now at the current market situation, then we can predict that it's likely to be rejected, and this sets us up nicely for a move to the upside. This is the first part of our analysis. We have an idea of the direction that price will move in, but now we need to determine the best place to enter our trade, and this is where the pin bar comes in. So just to explain, this right here is a pin bar. Remember that I mentioned before that the wick should be at least 2 or 3 times the size of the body. Its long lower wick signals rejection of lower prices, and it shows us that the sellers failed to push the price lower, and it provides us an attractive place to enter with minimal risk due to a very tight stop loss. But I'll explain this a bit later. As you can see, this setup is very simple to follow. It uses 2 techniques, the support and resistance with the pin bar, which both complement each other. Our pin bar technique builds on the analysis of our support and resistance, increasing the probability that our prediction is correct. As a general rule, keeping it simple also means that it's easier to understand why a strategy actually works, and understanding the mechanics of a strategy gives you more confidence to execute that strategy. Building a simple strategy is setting yourself up for a simpler route to a successful trading career. Take that with you. Principle number 2 is that a specific rule set is a testable rule set. A trading strategy is like a GPS navigation system. It should tell you exactly where to enter and where to exit a trade with as little margin for error as possible. We need clear instructions. We want to hear, take the next left on Burberry Avenue. We don't want to hear, it could be the next left or maybe right or whatever. We need clear rules. Specific rules are a must-have for a bulletproof strategy. They should be so clear that anyone can follow them. Essentially, you want to write a recipe for placing a trade, clear logical steps that follow one after the other. Avoid strategies which are not 100% clear, that don't follow in a logical order and that require guesswork or gut feeling, because these strategies are closer to gambling than trading. Remember that our trading strategy is a method of predicting the direction a market will move and profiting off that prediction. Now, a clear set of rules makes it easier to test your strategy and also means that you can rely on the test results, because those results are more accurate and closer to the results you can hope to achieve in the real market. Because the rules used in testing are the same as the rules you'd use in the real market. Rules that are unclear require some guesswork, and this makes every trade unique. If trades are unique, then you can't compare one trade to another, which makes it almost impossible to get accurate test results. Without accurate test results, you might as well be throwing your money away. So remember this rule. Let me show you an example of a specific set of rules. Let's take a look at the bat pattern trading strategy, which falls into the harmonic section of my 4 pillars model. A bat pattern is the result of a specific set of Fibonacci ratios that occur in a particular order. It provides a nice example of a profitable strategy that has clear rules that can be tested and repeated. Take a look at these rules. A solid rule set should function like a checklist, where we can go step by step and mark off each complete step as we go along. To illustrate how this works, let's find a bat pattern trade using the rule set I just showed you. Okay, so what we're going to do here is we're going to follow the rules, and I'm going to explain to you how we're actually using them. So the first thing we need to do is find an impulse leg. This is one of the most simple rules. This is our impulse leg from here to here. This is rule number 1. So this at the top here, this is X and this is A, as per the rule set. What we've done now is we need to use a Fibonacci retracement level to measure our X to A, and we're looking for a B leg which gives us a minimum of a 50% retracement. This is very, very close, but this gives us a 50% retracement, and therefore this becomes our B leg. The next rule is we basically need to use our Fibonacci retracement tool, measure from A to B, and we need a minimum of a 38.2%, and it touches that right there. And so basically we can draw this in. This is our B leg. And finally, for the CD completion, which gives us our entry point, we need a D level which completes at the 88.6%. So if I just go ahead and draw a line from the 88.6%, we can see it touches it right here, right at this candle. This gives us the completion. And so let's go ahead and complete this pattern. X to A to B, B to C, and then C to D, which is right up here. That's our D leg. And there we go, that's our completed back pattern, and that's how to use a rule set like a checklist. Principle number 3, exit as soon as your prediction is incorrect. A stop loss is your strategy for exiting a trade that is not going in your favor. Think of it as an escape plan when your prediction is proved incorrect. A successful trader must be equally prepared to deal with a losing trade than as they are to deal with a winner. One thing that separates successful traders from unsuccessful traders is that a successful trader recognizes that the real money is made in appropriately exiting a losing trade, getting your exit plan right. When you determine when to take a loss when a trade isn't in your favor, you should only be concerned about 2 things. 1. How do you minimize the loss? And 2. Ensuring that you've given the trade enough room to breathe in case the market turns around and moves in your favor. The best stop losses always have a reason why they have been placed at a particular level. They are never random. Avoid placing stops at random intervals such as 20 pips or 50 pips away from the entry price. Using a random stop is just another excuse for not really understanding the reasoning behind the prediction that you've made. Be sure to review your trade setup. Look at the prediction you've made and why you've chosen that level to enter the trade. Then you need to find the price level that would make your prediction invalid and use this as a stop loss. For example, let's use the trade setup I showed you in Principle 1, which is a bullish pin bar at a support level. In this setup, we are at a strong level of support where the buyers have previously held up the price and we're expecting them to do it again. We're predicting a reversal is likely to occur and that price will bounce from this support level. Now to confirm our prediction and provide an ideal place to enter, a pin bar forms at the level of support and now we're looking to enter at the close of the pin bar. What's the best place to put our stop loss? As previously mentioned, we want the stop loss to be tight, but we also want to give the trade room to breathe. If the market was to push down into the range of the pin bar, we'd still have a valid trade, but if the market pushes down further than the low of the pin bar, chances are that the trade is no longer valid and our prediction is incorrect. For this reason, we want to place our stop loss a few pips below the low of the pin bar. Okay, so now you have 3 principles you can apply to your trading strategy to make it airtight and more likely to succeed. Let me quickly cover 3 actionable tips that you can take from today's video. First, keep it simple and limit yourself to a maximum of 2 proven techniques from the 4 pillars of price action. Second, ensure that you have a clear set of rules which functions like a checklist and you can tick it off in a step-by-step format because that way it can be tested. And finally, make sure you place your stop loss at a price level which proves that your prediction is incorrect. Do me a massive favor, like and subscribe to this channel and visit www.trade.coach, check out our blog and subscribe to our mailing list to keep up to date with more content designed to make you succeed in the markets. Thanks for watching and I'll see you next time.